IPO or initial public offering is a unique process to convert a private company into a public company by issuing shares. The issuance of shares for the public allows the company to gather capital, and it creates an excellent opportunity for the general public to invest and earn returns on that investment. Initially, a private company grows with its initial investors, founders, and stakeholders. When a company has achieved a specific goal where the management realizes that they are stable enough to handle the Securities and Exchange Commission's regulations, grow and diversify using the general public's money, the company decides to offer an initial public offering. Through this, the stakeholdership in the company is offered to the general public through shares. Primary and secondary market. Primary market is where the company sells fresh stocks like IPO. This is the first place where the investors contribute to the company, and the company's equity capital is made by the funds collected by selling stocks in the primary market. Private placement and preferential allotment are two other ways in which stocks can be sold in the primary market after an IPO. In private placement, the company can offer stocks to significant investors like banks, hedge funds. This could be done without making the shares available for the general public. In preferential allotment, the company can sell shares to selected investors at a price which is not available in the market. Secondary market is commonly known as a stock exchange. This is where the stocks that have been allotted in the primary market are resold, purchased further by new people. A secondary market is where the investors trade among themselves, and this is the actual market. Types of IPO. There are two types of IPOs. They are dependent upon the type of price segment by the company is going for. These are two types. In fixed price offering, the company decides on the price of the stocks initially, that a buyer or investor pays that amount per share to obtain the desired number of stocks. In book building IPO, the company decides the price band of the forthcoming IPO, where the floor price is the minimum and the cap price is the maximum, and the bidding is done within this range. The price is set by the underwriter and the company's investors with surveys done on what would be the value of the share. The bids are made and the selected investors get the stocks. How are shares allocated in an IPO? There are different investor categories when it comes to IPOs. This includes qualified institutional buyers, non-institutional buyers, and retail individual investors. The allocation of shares differs for all of the above groups in an IPO. As an individual investor, you come under the last category. You are allowed to invest in small lots worth rupees 10 to 15,000. You can apply for a maximum of 2 lakhs in an IPO. The total demand for shares in the retail category is judged by the number of applications received. If the demand is less than or equal to the number of shares in the retail category, you are offered a full allotment of shares. When the demand is greater than the allocation, it is known as oversubscription. Many times an IPO can be oversubscribed 5 times. It means that the demand for shares exceeds the supply by 5 times. In such cases, the shares in retail category is offered to the investors on the basis of a lottery. This is a computerized process that ensures impartial allocation of shares to investors. Why does the company go public? To raise capital for growth and expansion. Every company needs money to increase its operations, create new products, or pay off existing debts. Going public is a great way to gain this much needed capital for a company, allowing owners and early investors to sell their stake to make money. It is also seen as an exit strategy for initial investors and venture capitalists. A company becomes liquid through the sale of stocks in an IPO. Greater public awareness. IPOs are star marked in the stock market calendar. There is a lot of buzz and publicity around these events. It is a great way for a company to publicize its products and services to the new set of customers in the market. What is the IPO procedure? A private company has to take various steps in order to go public. They are selecting an investment bank. The first step is to select an investment bank as an underwriter. Here the role of an investment bank is to help the company establish various details such as how much money the company hopes to raise, the types of securities that will be offered, the initial price per share. For a large IPO, there can be multiple investment banks involved. Creating the red herring prospectus. The next step of IPO process is to create a red herring prospectus. It is a document submitted by the company as a part of the public offering of securities. This is done with the help of underwriters. The prospectus includes various segments such as financial records, future plans for the company, potential risk in the market, and expected share price range. The prospectus is presented to the Securities and Exchange Board of India. If SEBI is satisfied, it greenlights the initial public offering process. In addition, it also gives a date and time for the IPO. But in case SEBI is not satisfied, it asks for changes to be made before the prospectus can be shared with public investors. Stock exchange approval. Listing is the process where securities are allowed to deal on a recognized stock exchange. But for that to happen, the company needs to be approved by the exchange. For instance, the Bombay Stock Exchange has a listing department whose purpose is to grant approval for securities of companies. The BSE has a list of criteria which needs to be followed by the company to be listed on its exchange. For example, the minimum issue size should be 10 crore rupees. The minimum market capitalization of the company should be 25 crore rupees. The minimum post-issue paid-up capital of the company should be 10 crore rupees. Only if the company follows this criteria, it gets an approval from the BSE. Subscription of shares. Once all the formalities are done, the company makes the shares available to the investors. This is done on the dates specified in the prospectus. Investors who wish to apply for shares have to fill out and submit the IPO application form. The shares are allotted to different investors based on the demand and the price quoted in their IPO application forms. Once this is done, investors get the shares credited to their demat account. In case of oversubscription, investors may not get the number of shares they originally wanted. They may get fewer shares after lottery is done. Some investors may not even get any shares. Thank you so much for watching this video. See you in the next video.